Hello and welcome to our second quarter webcast for 2023. We've got an exciting agenda again for today's webcast. So what we're going to do is cover several topical updates, spend a little bit of time on current, non-current classification from a balance sheet perspective, and we'll end the webcast with a spotlight on accounting for electricity contracts, focusing on the buyer's accounting. I'm Marie Kling, and today I will be joined by my fellow presenter, Gary Berkowitz. So we hope you enjoy this webcast.
Right, so let's kick things off with our list of countries that are hyperinflationary. Unfortunately, the list only appears to be going in one direction, which is adding more countries to the list. And so folks will note that Haiti is now on the list as well as needing to apply IAS 29 for June year ends and thereafter. If you have operations in Haiti, you should apply IAS 29. A couple of noteworthy mentions, though. Ghana and Sierra Leone, although they are not hyperinflationary as at June 2023, we do think, looking at the trend of the inflation data, that they will most likely become hyperinflationary by the end of the year. Maybe things will change. Hopefully they do. But folks with operations that have a functional currency of those two territories should prepare themselves to apply IAS 29 at the end of 2023. Another one worth mentioning is just Sri Lanka. We spoke about this in a previous webcast, but just to reconfirm that although Sri Lanka is teetering around the magic 100% cumulative inflation mark, it seems to have gotten things relatively under control, and the trend seems to be decreasing. So Sri Lanka remains on the watch list, but it's currently not deemed to be hyperinflationary, and we will keep you updated as we receive more information on Sri Lanka. Right, so next up is supplier finance arrangements. Now, folks may recall we spoke about this in our Q1 webcast, but the good news is the amendments have now been issued. They were issued at the end of May. Again, not to go into too much detail, there's a link there to our in-brief, but folks may recall that this was in response to investors asking for more clarity and transparency around supplier finance arrangements that entities may be entering into. And so their new disclosure requirements, for example, an entity may need to disclose the general terms of material supplier finance arrangements, where those supplier finance liabilities are actually sitting in the balance sheet, how much of the payment has already been paid by the financing entity in the middle versus the actual entity, what the payment dates or ranges may relate to. So there's a lot of new disclosure that's going to be required. But I think what's quite important here is that the board wanted to move relatively quickly. And so the effective date for this is actually for years beginning on or after 1 Jan 2024. So that's actually, next calendar year. And although that may seem a far way away, there's a couple of the disclosure requirements that entities may need to now put new processes and controls in place to obtain. So if you think, for example, about the disclosure requirement to be able to explain how much of the liabilities subject to a supplier finance arrangement have actually been paid off by the financier. So you may have to go to your bank or the third-party financier and actually now obtain information around how many of those liabilities have you as the bank already paid to my supplier, for which I now have to pay you. So how much of it has been paid and how much do you still have to pay as the financier? So some of that information may not be readily available. And so entities really want to think about putting, as I say, the processes and controls in place to ensure they have the information when needed. There is a bit of good news on the transition because, as I say, there's some transition relief. You don't have to restate your comparatives for the information. And also the board clarified that you do not have to provide the information in interim financials. So the first time we will see this information from a mandatory perspective will be our December 2024 year ends. But as I say, there's new information that you need to gather. So it's worth thinking about it sooner rather than later. And it may be that you want to provide some of the stuff earlier there in response to investor needs. Right, talking about international tax reform and Pillar 2, I think we've spoken about this in almost every webcast for the last 2 or 3. So hopefully, if folks have been watching those, they will be aware of what this is. This is a global tax reform. It's generally only applicable for companies who have relatively big revenues, so 750 million euros or above for a track record period. And if you are caught by this, it effectively starts capturing your worldwide tax to ensure that everyone pays their fair way. As I said, I don't want to go into a huge amount of detail. We've talked about the mechanics of how this works in previous webcasts. What is actually quite new from when we chatted last time is the board towards the end of May actually issued an amendment to IAS 12. It's good news. This is a good news slide. The board provided relief or an exception for entities that they do not have to, or they're prohibited actually, from providing deferred tax on any Pillar 2 related implications and disclosing anything related to the deferred tax implications for that as well. Now, that did come along with some additional disclosure requirements though. So there's a couple an entity is required when they do start paying taxes, or if they start paying taxes related to Pillar 2, if they're in scope of the requirements, they will need to disclose how much of their current tax is related to Pillar 2. And in the period in between the tax being substantively enacted, the Pillar 2 tax being substantively enacted, and the entity actually starting to pay, the entities are required to provide users with disclosure around what they think the expected impact will be. We would expect that at an early stage, because this is so complicated, that disclosure may not be relatively detailed. But as it comes closer and closer to an entity actually having to pay the Pillar 2 tax, we would expect those disclosures to become more voluminous and detailed. So watch that space. But as I say, it's good news that entities are not going to need to try and work out what the deferred tax implications are as a result of Pillar 2. So that's effective immediately. That's good news, as I say, but the disclosure requirements have specific transition provisions, and feel free to read the related in-brief, which tries to explain how all of those disclosure requirements interact with the timing. Right, and then a very brief update on sustainability disclosure standards. So the good news is the IASB will probably issue S1, which is the general disclosure standard on sustainability issues, and S2, which is focused on climate, by the end of Q2, and that'll be effective for years beginning on or after 1 Jan 2024, subject to local jurisdiction endorsement. And then folks who are following from a European perspective, the European Sustainability Reporting Standards, or ESRSs, will be endorsed probably towards either the end of Q2 or Q3 by the European Commission, and the first set of companies that will be required to apply those will be in 2024 as well. So things are moving pretty quickly now from a sustainability reporting perspective, and we will probably be issuing some in-depths or in-briefs in the coming months, so please watch this space. And staying with the topics related to sustainability and climate, we just thought it would be useful to make folks aware that the IASB is considering whether or not they are going to look at a project that considers climate-related risks in the financial statements. So it's at a very, very early phase. They're still, the staff is gathering feedback. It got discussed at the IFRS Interpretations Committee in June. And I think the board is then going to take the feedback they've received and determine if and what direction a project on disclosures related to climate risks should move forward, and how involved they should work with the IASB as well on it. So more to come in this space, but I think it's positive in that the board is responding to investor and stakeholder requests for more disclosures in the financial statements related to risks, and specifically risks around climate. So again, one to watch, because I think if it does move, it may move relatively quickly from a standard setting perspective. Right, and then moving to another topic which we've spoken a little bit about, which is presentation of liabilities as current and non-current at the end of the reporting period. And this one relates to amendments that were made both in 2020 and 2022. It's effective for years beginning on or after 1 Jan 2024. So again, the question you might be asking is, why are we necessarily talking about this in 2023? And I think the reason for that is because it's very important in a lot of cases when you have your significant financing and loans. Those will typically have some pretty important covenants, and understanding the terms and conditions of those covenants and how the new requirements may or may not affect the presentation of those loans or the classification is quite important if you need to renegotiate with the counterparty. Sometimes that can take quite a bit of time. So just to make sure that you are ready in advance of 2024. So a brief recap, what do the new requirements say? The new requirements, the ones that got amended in 2022. Well, the good news is that they actually are very similar in terms of how you determine whether or not something is current or non-current to what we do today. And so really the key principle that the board clarified, which I think makes it much easier to understand the presentation of liabilities as current and non-current, is that it is dependent on the rights and obligations that the entity has at the reporting period. And so you need to assess at the reporting period, do I have a term loan? And if I do, are there covenants attached to that term loan? And if there are covenants attached, what are the rights and obligations I have as a result of those covenants. So if at the reporting date, we've had examples of this in webcasts before, but just to remind folks, if at the reporting date, you have something that is going to be tested 2 weeks after the end of the reporting date, that does not affect the classification at the reporting date to the extent that it is still a term loan, because at the reporting date, you still have the right to defer for 12 months or more because you haven't yet tested the covenant. So I think, again, those clarifications really do help. It does come along with some new disclosures, so more disclosures around when you have significant covenants in loans, and also disclosures around if there were close calls or if there were breaches that were rectified before year end. So hopefully some more transparency coming to presentation of liabilities as current or non-current. Some key things to just bear in mind that I think we just wanted to highlight that you may want to think about before the standard becomes effective. There's a clause in the new requirements that says the right to defer must have substance. I think folks shouldn't worry about that one too much. We believe that's more anti-abuse. So provided all the terms in a loan actually have substance, we don't think that's necessarily a huge new bit of guidance to worry about. There are some key questions around what is a loan arrangement that falls into these new requirements, because I think the board was trying to address a very narrow scope issue. And so there isn't necessarily a huge definition of what is a loan arrangement. I think it's assumed you will know it when you see it. But that means some arrangements you may need to apply some judgment to work out if they're in the scope of these requirements. Similar to whether or not something is a covenant or a condition. Again, there's no hard definition of what a covenant or condition is. And therefore, in some cases, judgment may need to be applied to work out whether or not that is in the scope of the requirements because it is actually a covenant, or is it just really a repayment term as part of the loan? The next two items on the slide, it's nothing new really. Waivers that are breached or provided before period end and periods of grace, as well as rollover rights. The guidance hasn't necessarily changed from where we were before. It's just the logic of how you go through thinking about waivers and rollover provisions. I think the messaging will be similar to the messaging we have today. If you do have a loan arrangement for which you've waived a breach, either after the breach or just before, it probably makes sense to have a look to see whether or not the presentation and disclosure requirements have changed as a result of that breach or potential breach and the related waiver or period of grace. Similar to rollover rights, a lot of the time when we see rollover rights, one really needs to assess the terms and conditions related to those rollover rights. Sometimes they're provided in conjunction with subjective acceleration clauses or material adverse change clauses, which does create additional challenges in determining the correct presentation. So I think the messaging there is just be careful if you continue to have those types of arrangements moving forward. And as I mentioned before, the last thing really is there's quite a lot of new disclosure requirements. And that's probably, as I say, the biggest change. And that's things folks should probably get their heads around in advance of the new requirements becoming effective to ensure that you have the appropriate controls and processes in place to provide the new disclosure requirements. I think, again, we've got written guidance on that as well, so feel free to click through to the links.
Okay, so let's take a look at the accounting for electricity contracts. So why are we talking about this topic in our second quarter webcast here? Well, frankly, it continues to be a very topical issue, and we're getting quite a few questions on the accounting for these contracts, particularly from the buyer's perspective. So we thought it might be good to just do a quick rundown on some of the accounting considerations for these types of contracts. So what are we going to do? We're going to start with a brief summary on the scope of IFRS 9, and in particular, what we call the own use scope exception. So that's a scope exception in IFRS 9 for contracts to buy or sell a non-financial item when it's intended for own use. Now, that assessment will include looking at the meaning of delivery. So we'll take a look at that as well. We'll illustrate then the overall accounting for a physical power purchase agreement and also bring in some very recent developments at the IFRS Interpretations Committee. And we'll sort of wrap up this segment on electricity contracts by looking for contracts on the other end of the spectrums that are not physical power purchase agreements, but are virtual. So we'll look at what we call the VPPA agreements, so the virtual power purchase agreements. Let's start with the basics. So what is the IFRS 9 scope and what is the unus scope exception from IFRS 9. So IFRS 9 applies to a contract to buy or sell a non-financial item that can be net settled. So it can be net settled in cash or in another financial instrument. Net cash settlement in IFRS 9 includes a number of things. Includes the ability to settle net per the contractual terms. It includes circumstances where the non-financial item is readily convertible to cash. Circumstances where the entity has a past practice of settling net in cash or entering into offsetting contracts. But also circumstances where the entity is taking delivery of the non-financial item and then selling it within a very short period of time to realize a profit or a dealer's margin. So for the first two items, what happens is that an entity would have to make an assessment as to whether the unus scope exception criteria are met or not. So this would then entail looking at the contracts and determining whether they were entered into and continue to be held for the purpose and receipt or delivery of this non-financial item in accordance with the entity's expected purchase, sale, or usage requirements. So if those unus scope exception criteria are met, this means that a contract will be outside the scope of IFRS 9 and will be accounted for as an executory contract. Now, for the last two items on the slide, the entity would automatically be disqualified from meeting the unus scope exception criteria. So if you have those last two set of circumstances, these contracts would be in the scope of IFRS 9. But let's move on and take a look at sort of the meaning of delivery. As I mentioned, sort of when I kicked off this segment, a critical part of determining whether an entity is eligible for the unus scope exception is to look at whether there is delivery of that non-financial item. Now, there's not too much guidance in IFRS 9, but the IFRS IC back in August 2005 actually clarified what was meant by delivery. So what does that agenda decision tell us? Well, it tells us that delivery is one not restricted to physical delivery. The meaning of delivery could be met if there's an allocation to the customer's account. But it also tells us on the other end of the spectrum that synthetic arrangements resulting in delivery through an intermediary is not delivery to the end customer. So what does this all mean? Well, I think we can just illustrate sort of these concepts for a couple of examples. So let me start with a first example where a customer might contractually purchase the power at the point of generation. So that is the interconnection point to the grid or the transmission system. It sells the power into the grid at that point at the spot price and then instantaneously repurchases at least the same quantity of power at the site where it requires the electricity at the spot price. So where the customer is obligated under the contract to instantaneously repurchase at least the same quantity of electricity from the grid in which the electricity was contributed, this would be considered physical delivery to the end customer. Now, let's compare that to another example. And on the other hand, we might have a contract that might just net settle the difference between the fixed power price in the agreement and the spot price for the sale of electricity. Now, in these cases, the generator would sell the power into the electricity grid as a principal, and then the physical power is not, quote unquote, delivered to the customer. So the customer there might consider that they're notionally purchasing electricity, but because it's not delivered to the customer, it wouldn't meet the meaning of delivery in that particular circumstance. So again, quite a critical assessment there as part of the unus assessment. But let's try and bring this all together and just illustrate the accounting overall for one of these contracts. So let's start with a very simple scenario, just to illustrate the considerations for a physical power purchase agreement. And sort of we've got a fact pattern here on the slide. But we're focusing our analysis on IFRS 9. And I just wanted to put in a quick reminder that an entity, of course, before going to IFRS 9, should also consider whether the contract to purchase electricity is a lease. So where a customer is not physically purchasing substantially all of the output from the identified asset, the contract would be unlikely to constitute a lease. And so indeed, in practice, and frankly, my experience, customers are often purchasing only a percentage of the output of power that's produced, so let's say 20%. And so generally, again, the contract would not constitute a lease. So that's why here in our analysis, we're really focusing on IFRS 9 because we're assuming that IFRS 16, the leasing standard, would not be applicable in this particular scenario. Here we have a contract. So the buyer enters into a contract with a wind farm. So we're looking at the buyer's accounting to purchase 20% of the electricity produced by the wind farm for 15 years. The buyer also receives one renewable energy credit, one REC, per megawatt of electricity purchased. It pays a fixed price per megawatt of electricity. It operates 24/7. And we've assumed here that its electricity needs well exceed the volume to be purchased from the wind farm at any point in time. And the buyer here also intends to take delivery of those renewable energy credits to cancel in its own operations. So in this very simple scenario here, the unus criteria would be met and the contract is accounted for as an executory contract. So the contract here is outside the scope of IFRS 9. Now, of course, this is a very simple example. And as we all know, in practice, things get a little more complicated. And so the answer also gets a little more complicated. So for example, if the buyer only operates day shifts from 8 a.m. to 8 p.m. each day of the week, it would be more challenging because in such a case, the contract would have to be negotiated to only require purchase during the on-peak times to meet those unus criteria. And actually, that's a good segue into some of these recent developments at the IFRS IC. Because there was a submission with one of these more challenging scenarios. Now, the submission itself included 3 scenarios, but the first scenario that was submitted to IFRIC was actually sort of related to what we're discussing here. So in that fact pattern, the buyer was required to purchase a fixed share of the energy produced by the wind farm on a 24/7 basis. But unlike the simple example I've described, the buyer there does not operate 24/7. And what it then does is arrange to sell the unneeded energy at spot prices during those non-operating periods because it cannot store the electricity. And so, of course, the question there is whether the buyer fails unus because the contract in its entirety cannot be considered to be entered into for unus purposes. Now, at the meeting on June 6th, actually, there was quite a lengthy discussion, very active discussion on all of these accounting challenges relating to this issue where the electricity cannot be stored. And the ultimate decision at the meeting was actually to refer this matter to the board, so the IASB, for further consideration. So please watch for further developments in this space. But let's move off from the physical power purchase agreements and take a look at a fact pattern or a scenario at the other end of the spectrum, where it's clear that there is no delivery of power. And so these agreements are typically referred to as virtual power purchase agreements. So again, virtual as opposed to physical here because there is no delivery of power. Let's take a look at an example. So we have a contract here, and we're looking at the buyer's accounting as well. So we have a contract that is non-deliverable for power that only provides the delivery of renewable energy credits. The buyer here pays a fixed amount of 20 currency units per megawatt for 20% of the electricity that's produced by the wind farm for 15 years. The buyer also receives 1 renewable energy credit per megawatt of electricity that's allocated to it by the wind farm. And now the difference between the contract price, so the 20 currency units, and the spot price per megawatt will now be settled net on a monthly basis. So when we analyze this from the perspective of the buyer here is entering into sort of a virtual power purchase agreement with the delivery of renewable energy credits. And so we'd have a host contract for the delivery of those renewable energy contracts. with an embedded electricity swap. So that's a swap that settles net between the fixed price in the contract and the spot price. Now, this embedded derivative we would not be considered closely related to the host contract. And so what we have to do here is actually separate out the embedded derivative and account for it separately. And so that derivative will then be accounted for at fair value with changes in profit and loss. The RECs, on the other hand, will be expensed when used. Now, however, bifurcating and separately valuing embedded derivative can always be challenging. So what the entity could do here as well is just choose at inception of the contract to actually account for the whole contract, so the host and the embedded at fair value through profit and loss. And that's sometimes done just to simplify some of the accounting by fair valuing the whole contract versus just having to separate out an embedded derivative. Again, so you can see that, for these virtual contracts, the accounting is quite different from what I described earlier for the contracts that provide for physical delivery. And so that's, again, a quick summary of the issues in this space and their related accounting considerations. So again, a lot to think about and a lot of complexity when looking at these contracts overall. Okay, so this brings us to the end of our second quarter webcast. We certainly hope that you found the content useful and hopefully also interesting. We've got a slide here at the end that lists all of the resources that you can refer to and where you can find more information on any of the topics we discussed. So thank you very much for listening to us, and we'll be back again for our third quarter webcast sometime in September. Enjoy the summer and speak to you soon.